Good evening, everyone. Today is week number 10 for our course we're now on chapter 15, investment banking. There's a common stock and then preferred financing, but I would want to discuss more on the investment banking. And investment banking is actually going through what we discussed with regard to capital markets. So last week, we discussed about capital markets. We talked about what's the money market, what's an investment, or what's a capital market. And then now it's a discussion on having a company get that investment on that market. So we'll walk you through the process. So it's called investment banking. Now, similar to last week, there is no quiz. It's basically a discussion, right? But I do hope, even though we don't have any quiz, there will be a work for you to actually watch or listen to the videos and even read your books, right? Those are important aspects. Right now, just to make sure that we have some reinforcement, we create the videos. I'm sorry, I'm actually still traveling right now, and I still owe week number 8 assignments that I would need to grade, which I'll be doing soon. So let me work on that one, and then I'll catch up on that. So for those who have not finished some of their assignments, do please submit it to me because we're on the tail end of the course itself, right? So I'll go back and forth with regard to the PowerPoint and then also with the Excel file provided. So I'll go first with the PowerPoint. Now, when we talk about investment banking, we talk about here called IPOs, right? So IPOs is initial public offering. So initial public offering means that your company that is held in private would actually be made into a public corporation. So it would mean that that public company will be listed in a private setting or in a public setting, meaning that it might be the New York Stock Exchange, it might be the Shanghai Stock Exchange, it might be the Japanese Stock Exchange in Japan or Singapore or wherever in the globe, right? It doesn't have to be the United States. Now, what will happen now is that the reason why a private company is being listed publicly, it's because it needs more funds. So that initial public offering actually helps the company get a lot of capital at one point in time, right? So here, the IPOs in 2014 to 2021, you would see the major ones. Most of us know what's Alibaba, like a big conglomerate in China. Saudi National Commercial Bank. We see Airbnb before it was a privately held company, and then because of its popularity, it became listed, right, in the Nasdaq, which is a dealer's market that's automated or an exchange that's automated. Now you also have Doc Martens, the makers of shoes, and then ADT for security, and then Trivago. Trivago is actually a platform like end-to-end travel booking, hotel booking, and everything else in between, right? So these are the listings. So I'm going to go first on the IPO process. So let me go there. Let me switch, and then I'm going to go to our Excel file. So in our Excel file, we actually have so we have three: the IPO process, public financing, and then the LBO. So I created one file. So let's do it this way, right? It's a big file when you think about it. It goes down. It has subsections, right? We will go through it because this is actually a big mind map of investment banking as regards to IPO. So I'm gonna make this big first, and then let's think about first the IPO, right? IPO. IPO is initial public offering. It's the process which a private company offers its shares to the public for the first time. So there are two types of investors, right? So if I buy a stock, you and I will buy a stock. So we are called a retail investor. So how do you buy a stock? I open a bank account with Vanguard, then or a brokerage account with Vanguard or any investment houses or Fidelity, right? And then I will buy it directly or through a brokerage account. Or I can open a fractional shares type of app, an account also. So remember Robinhood? So Robinhood is an app that's popular in the United States. It could not do transactions in Guam. I tried at one time. And then basically it buys fractional shares, like less than one share of something. So for example, think about fractional shares as, can you buy one Bitcoin? I think I haven't checked how much is Bitcoin. It's not stocks, okay? Bitcoin is actually a coin. Um, so a cryptocurrency. So one Bitcoin is 67,000, give and take at one high point. So of course that's too expensive to buy one token or one Bitcoin, 67,000. So what we do is that we buy a fractional or a fraction of that one token. It might be point something something or less than one, definitely less than one token. So that's a fractional share. Similar to stocks, you can get fractional shares or you can get shares of stocks by going through by being an investor on a broker market. So IPO is a company going through the initial public offering process, and then it would actually be selecting an underwriter who is normally an investment bank that will guide the company going public. That's why it's private going public through the IPO process. Now, I wanted to make sure we understand what's the reason why people are asking for an IPO. Because if you go through an IPO process, you have access to capital. So people have access to capital. They're able to pay down maybe a big loan that they have, or they might be funding a big investment. Like say, you would like to establish a data center, like big investment. You would like to establish a solar panel or you're part of Tesla's or your Tesla, you want to have a Hyperloop, the one going through LA, or you want to invest on the next generation SpaceX or something. Or one of the newer ones that I've seen or heard or read is basically why not get solar power, not from the ground, like an Earth station or a solar panel in the Sahara Desert, right? They wanted to have solar power through a spacecraft in basically in orbit so can get solar power and then that spacecraft would beam it back on an earth station, for lack of a better term, using microwave like infrared. Like, okay, that's way too big in a way like Gundam style conflict. Well, that's a different reference on an anime, but like that's basically one of the premise on one of the Gundam series on control of power, basically, like solar power energy. Now, so those major innovation requires capital. It's big. And then access to capital, if you're a private company, you can go public. Now, liquidity means that once you go public, you will get a lot of liquidity because there are early investors who would actually maybe buy your stock and then sell it out and make money out of it as it goes to the secondary market. And then a lot of companies, like the company that I'm working with, so we are a private company. At one point in time, we're thinking it would be good to have an IPO process because it's like a badge of honor, right? Um, a badge of honor because what will happen is that if there's an increase in credibility with regard to how you're going to be working on a more regulated environment. So from private to public, you have a more regulatory, more compliance, more governance type of process. Okay, so that's the reasons why people will go to public. Now, investment or the IPO is the process of listing to get your company shares on public for the first time. And then now, what does the company do? The company needs to ask or hire or select and hire an underwriter. So let me just make sure I can mark it. So you need to have an underwriter. So what's an underwriter? So an underwriter is normally a investment bank, an investment bank that would guide a company through an IPO process. So it would help determine, say, hey, how much capital do you need? Okay, here are the number of shares that we need to issue for your capital that you need. And then let me make sure, the underwriter, we can set the initial purchase price per share of your stock. And then at point in time, an underwriter can be the one buying all the shares or some or most of the shares of the company being listed, and then they would take responsibility of reselling it or selling it to the dealer market. Okay, so that's actually the underwriter. Now, the question is, let me go here. The question now is, what are the banks that are called underwriters? So let's go here. So I have something here in gray. So Goldman Sachs, which I did not make it red, Goldman Sachs is actually a big investment bank. So it has some tech IPOs that it has done recently. Morgan Stanley is another underwriter, a major bank also, Morgan Stanley. I could, they're noisy. I could not, I could. Jerome, thank you. I cleaned it up, but like, I need to just, yeah. I needed to move up because they're just, I'm not even there. Annual Jerome, I'm just gonna do it only in one shot. You're ready. Roma, can I use this one? I just need to record something this way. So, okay. Um, yeah, okay, okay. I'm just gonna record something really quick. Okay, sorry. I actually just like did a quick pause and then just want to make sure I recalibrate. So you can hear me properly, right? Now, we talk about the underwriters. One of the underwriters is actually Goldman Sachs. We talked about it. These are big banks. Investment banks or underwriters are basically investment banks. Some companies call, or some people call it IBs, right? I and then B, Indian Bravo. So it's like working for the big four. So if you're an accountant, you wanted to take the CPA exam, you work for the big four. That's EY, KPMG, and then Deloitte, and then PwC. Now, if you wanted to go to finance and you want to take uh, banking or the field of finance, then you work with an investment bank, right? So the other investment bank that I would like to show you is actually JP Morgan. So JP Morgan, it's in finance and then tech, and then you have, I think they changed the name already. But right now, so normally it's called Bank of America Merrill Lynch. It's actually an investment bank as well. And then Citigroup. So you might have a credit card, which is actually Citi card or whatnot. So Citigroup is actually an underwriter as well. And then Credit Suisse. Credit Suisse is actually mostly in Europe. They're very strong on that one. It's mostly biotechnology and then some underwriting presence on industrials and also Barclays. So Barclays is actually mostly in Europe. I would see, but I would see them. I think in Guam we have Barclays helping out some of our government government in Guam issuing bonds. I would say at the airport, but I need to check, right? The Guam airport. And also they have a Deutsche Bank. So Deutsche Bank is also doing investment banking. So where are we at? We are looking at an IPO. IPO is a company that's private that needs to go public. And then the first thing, why would they do that? Because they want to get access to capital. The first thing that they need to do is to get an underwriter. So that's the most important thing. Now we talk about who's an underwriter. What we need to talk about now is that what is the process of underwriting? So I'm going to go here from gray all the way to blue right now. So on the blue side, underwriting is the process by which an underwriter, um, which is actually an investment bank, so it will make an assessment, evaluation of the company. So you wanted to list to get access to public capital. The underwriter is going to value or assess your company, and then it would also assume and manage the risk associated with selling your stock to the public, right? So it can be an IPO can be a debt instrument or it can be an equity offering, but it's mostly on the context of the IPOs is on equity mostly, or more likely than not. Now, like an underwriter is a market maker. That's actually how we have it described on your book, right? So why is it a money maker or a market maker? Because it involves buying and then selling the shares in the open market. So, for example, you're going to be listing, you want to go public, you have 1 million shares, and then price at X number per share. So it needs to make sure, the underwriter, that there are investors, institutional investors. So we talk about you and I. You and I are retail investors. We go to an app, we buy fractional shares and whatnot. So the other type of investors, other than retail, is what we call institutional investors. These are big pension plans. These are big corporations that are basically selling also and investing other on other markets, or these might be private equity that would want to buy a big portion of an innovation that you have as a business. So those are because it's institutional because they buy large sum of investment, unlike us retail investors, right? Now, um, advisors is also a role of, or advisory is a role of the underwriter. They provide the guidance on the process of listing. Why? Because when you go public, there's a lot of compliance and regulatory requirements. You are issuing securities, so it means that the U.S. Securities and Exchange Commission, you need to follow the rules of the U.S. SEC, right? And then it needs to go through a lot of uh, filing requirements, tax requirements, legal requirements. So them as an investor, they would help you, the underwriter, to make sure that you properly file an IPO and go through the IPO process. Now, We talk about the underwriter's role, and then those are the major roles of the underwriter. And then last one is the agency function. So it actually acts as a middleman or intermediary for between the issuing company, the one private going public, and then the public market. The public market meaning that they're the dealer market, institutional investors, the ones who would buy your stocks. So they would like to make sure that they sell the company stock to investors, then distribute the stock and make sure it actually manage the communication with regulatory authorities. So that's the agency role or agency function of the underwriter. Now, I'm going to go up a bit because we want to make sure we have a discussion on the underwriting process. So we go from a blue box, then this one goes into two. I have this. So if you are an underwriter, who are the underwriters? These are the companies, right? As discussed. There are two types of underwriting, meaning that there's a firm commitment and then best effort. So what is a firm commitment? A firm commitment is actually wherein the underwriter agrees to purchase all. So that's the operative term. All of the offered shares from the issuer, the private company, and assumes the risk of selling them to the public. So it basically guarantees capital for the issuing company and then takes on the risk of the shares if the shares don't sell. So basically, you as a company applied and or wanted to go access to public capital, and then you actually went through an underwriter, engaged an underwriter, and then the underwriter said, okay, this contract is a firm commitment. So that 1 million shares that we talk about, the underwriter will buy it all from you, and then they will take care of selling it. Might be good, might be bad, right? Depending on how big is the industry. If it's a tech innovation, how attractive your industry is or where you're at as an industry. If you're the first one, a leader rather than a laggard on your industry, or you might be the only one in your industry, then that's actually how you do it. Now, on the best effort, here is actually an understanding with the underwriter we're in. The underwriter agrees to make its best effort, as the term says, best effort to sell the securities, but does not commit to buying the unsold portion. So if there's something, I don't want to say it's consignment, but it's like consignment, right? I'll do best effort to sell everything of 1 million shares. But if there's something unsold or nobody would want to buy it as a like the first offering. So IPO is the first listing of the shares, right? Because why? Let's do it this way. I'm an institutional investor. I buy from an IPO. So it's the first transfer or it's the first buy. Then if me, the institutional investor, sells it out because it doesn't look attractive, which is not a good thing, you would want the institutional investors to keep your stock because if your buyers abruptly sell your stock, then the market might think like, oh, there's something wrong with this stock because they're selling it out, they just bought it. So sometimes they can see that one, the trade, right? Like you went to an IPO on this date and then the stock goes up, but the purchase goes up and then everything is selling. So that's not a good thing. Or a day after people are selling, then the stock price changes. So when they sell the initial buyer, it will now go to the secondary market, right? Something like that. So there's no commitment on best effort, and then this places the financial risk on the issuing company and may not be able to meet their target capital if the demand is not met, right? So let me make sure I actually clean this up. And then here, I'm gonna clean it up. If the demand is not met or the demand is actually low, there you go. I'm gonna make sure we mark it properly. There you go. Now, we're still on the IPO process, and then here I have another line. I know it branches out, right? Because there's a lot of new concept that we want to make sure we cover. So there's a third line there. We're gonna go there. Can I use my finger to actually take a look at it? Now, you would say that, hey, you know what? On the gray side, there are a lot of investment bank as a company listing, right? So is there only one investment bank when you hire someone to make a initial public offering? So there are scenarios we're in. In most cases, I would say, there's only a single bank that would lead the IPO process. So they're called the lead underwriter. And then you being the underwriter, you're also what you call the book runner. So I know that's a new term, right? So lead underwriter, basically you're the one taking the lead. Then what's a book runner? So the book runner is responsible of identifying who they can sell the initial stocks to, and then how much are they actually pricing it, or how much they think they want, or the investors want to buy the stock. So that's actually the book runner, like basically keeping the books, or keeping the listing of the stocks, or who are interested in buying your stock through an IPO process. Now, there are certain cases wherein you might have multiple banks. So this is what you call underwriting syndicate. So syndicate means that, well, I was going to say a mafia, right? Syndicate, but that's on a bad term. Syndicate meaning that they have more than one. So in a more or large complex IPO, there's a lead underwriter, and then they might invite other banks to form a syndicate, because they're actually. So why do you actually have more than one? Because you want to spread the risk. So that's the reason why. And then sometimes the IPO might have joint, so multiple now, joint book runners and then co-managers. So you can do whatever setup that you would want, right? Now, I would want to actually show you here on what's happening on a concept called underwriting spread. I think we have talked about spread as a term before when we say that the bank makes a margin or makes money by including a spread on the interest rate that it actually got the capital that they need to give to you. They will give you so they make margins based on a spread that they will give you based on a percentage or a basis point. So for underwriting, it's the same. Underwriting spread is actually the fee that the underwriters earn for their services in taking a company public through an IPO. Taking a company public means that you're a private company. You're taking it to become public by issuing shares of stock in a regulated industry through the stock exchange. So it's calculated as the difference between the price at which the underwriter buys shares from the issuing company, the offer price, and then the price which they sell it to the public. So, for example, here's one thing, right? It's actually on your book. The offer price is actually $20 per stock. And then, but it goes to the public at 21.50. The differential of 150 is actually shared among the members, depending on. So the 150 here, the difference between what is being charged to the public and then what is being bought. Remember, the underwriter can have a firm commitment to buy all the stocks. And then now it would actually sell it to the public or to the market or to a dealer. So the investment bank can sell it to a broker, can sell it to syndicated members, can sell it to certain dealer groups or the public. And then, of course, as you sell it, it actually has different prices. When it goes to the public, it's actually more expensive. Why is that? Because the public would only buy fractional shares, but when you buy the dealer, they buy it in big volumes because they want to trade it out, the buying and selling. That's the dealer's market, right? Um, that's why. there is power in numbers. If you have more volume, then the price of the stock might be cheaper compared to buying it only in a few, like a few shares, right? So the difference between what the offer price and what is actually being sold to is the spread, because it can be a spread between the offer price and syndicated member. It can be a spread between the offer price to the broker, or the price offer price to the selected dealer group, or all the way here to the public. So that's basically the underwriting spread. So basically per share you earn, and then if you have $1 million worth of shares, actually it's more like 10 million or whatnot, big numbers, then that's what it is, right? Now we talk about we're gonna go back here. So number one, we know about what's an underwriter. Then the underwriter, before, so the underwriter looks at this, they did the compliance, they're helping you set up, and then now there's a book runner, and then they have an agreement between a firm commitment or best effort. Now you need to establish the price of the stock. So that's number two, right? So before the stock is sold by the underwriter to the channels that we saw a while ago, the dealer, the broker, the public, institutional investors, pricing is important. Now, pricing, I'm going to delete this one. That's the one on top. I'm going to go now from number two. Then I'm going to go to A, B, C, D, all the way to letter F. So bear with me. We're going to go from left to right, then down, and then left to right again. So in order for the underwriter to put a price on your stock, you need to have a valuation assessment. What's the valuation assessment? The company or the underwriter takes a look at the company and does analysis, similar to what we've learned in the first few chapters of the course. You do ratio analysis, you do ROIC, you do ROA, you do EPS, you do. Hopefully, you still remember those because we're going to be using that on the later part of the course. Before the end of the course, we're going to be analyzing a financial statement, which will be a mini preparation project rather than an assignment for us, right? So I'll include that as part of the Canvas requests or preparatory work before we end the semester, right? Or the tail end. Our final project, which is reviewing a financial statement. Now, so you do the company valuation and then you do some comparable analysis depending on the industry that you have, the price earning ratio, price to sales ratio, and whatnot. Now, once you do a valuation, or once the underwriter does a valuation of the company and where the industry is at, it sets a preliminary price, and then it does a S1 form US reporting. I know it's not on the book, but just wanted to call out the form that they use to actually do a price range, right? Now, what will happen is that it's still the underwriter who did a determination of the initial price range based on the company's performance and assessment of the future performance, the company's strategic plans, and then where the industry is heading. Now you need to test run it. What do I mean test run it? So the CEO and the chief financial officer of the company will go through a roadshow. So we call it a roadshow. Roadshow is actually the term that's being used, right? So it's the executives and the underwriter will do a series of presentation of to potential investors. Say institutional investors can be those on the pension or mutual funds, hedge funds, and then pension funds. And then now they would say, okay, they would like to get the feedback from those investors on the level of interest and then any opinion within the price. Like, is it a good price? Is it too high as a valuation based on what the company is being looked at in the future, right? So basically, they will do the roadshow to make a market test of the price that they initially set. Now, I'm gonna go to letter D. So remember that runner, right? The book runner, so which is also the underwriter. So they will now do a order book and demand analysis. So as the investors are interested in buying the stock, they would say, okay, how much are you thinking of buying, those institutional investors, based on that roadshow? Um, and then also, sorry, I'm going to move it here. And also telling them like, okay, what is the price that you're thinking that you are able to buy? So they're doing that listing, and then by blocks of thousands, 100,000s, here's the price that they're willing to pay. Then they're listing it down. Now, the underwriter is now going to make sure that they have a final decision on the offer price. So the offer price does not just come magically, it needs to go through a process. So the final decision is being made on the night of the IPO. So I've heard some horror stories wherein before they go to an IPO process, everybody's trying to consider all the market information, and then they're trying to do a proper calibration of the offer price. And then the first few hours, when the stock gets traded, you wanted to see that it goes up, right? And then rather than people buying it, then selling it immediately. And then also, here's an important role of the underwriter is actually the aftermarket price stabilization. So imagine this one, the night before the IPO, you remember people ringing the bell in the New York Stock Exchange. You might have seen a news wherein they ring the bell, and then when they ring the bell, um, basically the stock trade floor is actually open, and then people are buying the stocks, right? So market stabilization or price stabilization means that the underwriter, if they see that the demand or the price is going below the offer price, they might buy on their own the stocks to make sure it's not going to be volatile, right? And then so it would actually be like stabilizing the price and then making sure that there is some uh, there's no big fluctuation or big move, because if not, then your IPO will not be a success. So it's a bit crazy when you think about it. I have here something. I'm gonna go to the pricing security. I'm gonna go here to the Dutch auction. So wanted to give you an idea of what is a Dutch auction, right? So a Dutch auction is a pricing method that allocates the shares in an IPO that lets the market directly influence the market price. So Google did the Dutch auction. So how does it work? Investors would submit a initial bid of how much the shares that you're willing to buy and then the price. Then they would, or they, the underwriter, would do a clearing price. They would determine the clearing price. Basically, they will rank highest to lowest, and then they would say, here's the clearing price or the stock price, and then they would allocate it. Let me just do an example. An example of Dutch auction pricing is basically democratize, democratize the process of setting the price. So, for example, the company is offering 1 million shares through a Dutch auction process. So the bids are, so you collated the bids, 100,000 for $100, 200 for 90, 300 for 85, then some buys 575. So now how do you set the price? All the prices are different. So you're just gonna say, I'm gonna start from high to low, and then I'm gonna add 100 at 100,000 shares at $100. 200,000. If I add both, it's now 300,000 accumulated. How much do I need? 1 million shares. But I'm doing highest to lowest, right? So it makes sense. So 300 plus 200 plus 100 is now 600 shares. Then 400 plus the 600,000 shares, I'm going to stop here. So 80 is the target share to be issued in the IPO. So you start from the highest bid, and then it aggregates all the demand until it meets or exceeds the 1 million shares offered. So in this case, the bids at 80 and above would total 1 million shares, setting the clearing price or the strike price at 80. So all investors who bid 80 or higher would receive shares at 80, and regardless of the specific bid price. So um, these folks who would buy 100, they're lucky because they would still get it at 80 because that's actually doing the Dutch auction pricing. So it's actually good because it helps out with um, uh, making it more transparent. And then rather than people pricing it differently and then price stabilizations and whatnot. And so it's basically um, a lot of transparency in that process. So I know that this is actually a big file, which is a lot of processes. So this is actually how we looks at it. And then this is the first video that I'm doing. We still have public and private financing and then a leverage buyout. So I'll stop here and then we'll see you on the next video. Thank you, everyone.